If you want to build the most wealth possible over the next 20 years using ETFs, you need to start by understanding what maximum wealth really means. It doesn't mean finding a magical ETF that beats the market every year. It means building a portfolio that grows consistently, survives crashes, and compounds over time. That means it needs to be stock-heavy, globally diversified, ultra-low cost, and something you can actually hold on to when the market drops 40%, because it will, probably more than once. So the best ETF isn't just the one with the highest return, it's the one you can stick with for 2 decades without panicking. Now, let's talk about the 4 principles that actually drive long-term wealth. First, stocks outperform bonds and cash over time, so you want high exposure to equities. Second, diversification matters. You don't want to bet everything on one country, even if it's the US. Third, costs eat returns. A 1% fee might sound small, but over 20 years, it can cost you tens of thousands of dollars. And fourth, behavior is everything. If you sell during a crash, you've already lost. So build a portfolio you can emotionally handle. With that in mind, let's break ETFs into categories that support long-term growth. First, core U.S. stock ETFs. These are the backbone. Think VTI, which holds the entire U.S. stock market, large, mid, and small caps, or VOO and IVV, which track the S&P 500. All of these have expense ratios around 0.03%. They're cheap, diversified, and tax efficient. Second, international stock ETFs. VXUS gives you exposure to developed and emerging markets outside the U.S. VEA focuses on developed markets. IEFA is similar. These help reduce the risk of being all in on one country. Third, emerging markets ETFs like IEMG or VWO. These are more volatile, but they give you access to fast-growing economies. Fourth, one-fund global ETFs like VT. VT holds the entire world stock market in one ETF. It's simple, diversified, and rebalances itself. Fifth, dividend ETFs like SCHD or VIG. These focus on companies with strong, consistent dividend growth. They're not magic, but they can help some investors stay invested. And sixth, growth or tech-heavy ETFs like QQQ or VGT. These can outperform, but they're also more volatile. QQQ, for example, once dropped over 80%, so use them carefully. Now let's look at how to combine these into actual portfolios. Option 1, the one-fund portfolio. Just buy VT. That's it. You own the world. It's simple, it's diversified, and it works. Option 2, the two-fund portfolio. VTI plus VXUS. You control how much US versus international you want. Option 3, the core satellite portfolio, VTI and VXUS as your core, and then maybe 5 or 10% in QQQ or SCHD as a tilt. Option 4, add bonds if you need to sleep at night, maybe 80% VT and 20% BND. That lowers volatility and might help you stay invested during crashes. Now, what if you're comparing similar ETFs like VOO versus IVV versus SPY? Don't overthink it. Look at the expense ratio, tracking error, liquidity, and tax efficiency. If they're all low cost and track the same index, just pick the one available in your account and move on. You're already winning. But here's the thing. The ETF you pick matters less than what you do with it. If you panic sell during a crash, even the best ETF can't save you. So build a portfolio you can hold through a 50% drop. Also, use tax-advantaged accounts when you can. ETFs are tax efficient, but you still want to avoid short-term capital gains and unnecessary trading. In taxable accounts, broad index ETFs are usually best. And if you're harvesting tax losses, make sure you avoid wash sales. Now, let's talk about what not to do. Don't chase hot sectors like AI or crypto just because they're trending. Don't overload on tech or dividends. Don't confuse dividends with total return. And definitely don't use leveraged or inverse ETFs for long-term investing. Those are designed for short-term trades, not 20-year wealth building. So what's the best answer? If you want the highest probability path to long-term wealth, here it is. One fund solution, VT. Two-fund solution, VTI plus VXUS. Optional tilt, add a small slice of QQQ, VGT, or IEMG if you understand the risk. But remember, the best ETF is the one you can hold when it's down 40%. Now, if you want to personalize this, ask yourself a few questions. What kind of account are you using? Taxable? 401k? IRA? How would you react if your portfolio dropped 50%? Do you want simplicity or control? Are you optimizing for maximum return or maximum peace of mind? Answer those, and you can build a portfolio that fits your goals, your risk tolerance, and your behavior. Because in the end, the best ETF strategy isn't just about numbers. It's about building something you can actually stick with for 20 years, through booms, busts, and everything in between.